Securing land is one of the biggest oppositions most people have, because you sit back and go, okay, I'm gonna be committed to this piece of land and I don't have no money to buy the land. And it's one of the biggest oppositions that people have, and it cusps them. It pierces their ability to go out and take down a deal because of fear, and only fear. It's the lack of knowledge and fear. So let's overcome and let's conquer that fear right now by sharing with you guys how Jerome ties up land, how you control land without having to come out of pocket with a ton of money. Okay, now, is there money involved? The larger the project, and yes, there is money that has to come out of pocket the bigger the deal gets. So when you're first starting, little acquisitions, it all works the same way. Whether you're buying a piece of land to build a house, whether you're trying to buy a piece of land to build an apartment complex, whether it's big or whether it's small, there is going to be some money that has to come out of pocket to at least secure the land. Now, you don't have to pay for the land, so if the land's $150,000, $1 million, or anything in between, smaller, larger, it doesn't matter. All of the way that you negotiate is all written the exact same way, and it's all in the paperwork. And so most people get cussed because they don't know what they don't know. So let's teach it to you. So one of the biggest things is that you can secure the land and control the land without owning the land legally on paper by putting the land in escrow. So everything that we do is based on timing, execution, and minimal contingencies. Let's talk about what that looks like, okay? Because that's a loaded statement. What does all that mean? Well, let's go through it. So when we go in and we love a piece of land, you tell the seller, I love your piece of land, I want to buy it, right? Like, that's essentially what you're telling them. Otherwise, you wouldn't be buying the land. You go in, you have some due diligence, even though you love the land. Is the deal going to work? Can I get the zoning that I need? Can I go out and get the permits that I need? Can I get enough density to be able to make the project pencil and financially viable? And so for a lot of you guys that are already following our content, I'm covering this stuff, right? Like, I'm covering how to underwrite these deals, how to underwrite the value of the asset, how to underwrite the expense and the cost to build these assets. But how do you tie it up to be able to get these working pieces to work along with you, to be able to make it happen where you can get the money from the bank, and that lag time in between the time that you actually secure the land and you get the money from the bank to pay for the land? What does that look like, that time? Because on some residential deals, it might just be 30 days. For some of you guys that are doing larger deals, it might be 3 months, 6 months. For those of you guys that are doing big acquisitions like the one I'm standing in now, something like this might take over a year just to be able to get out of the ground and get to the finish line with lending. And how do you get a year to be able to go out and tie up land? So when we go in and we go in to structure a purchase agreement, here's how we control it without a lot of money out of pocket, but we still are able to crush multifamily deals, because there's plenty of land out there. And one of the biggest things is you drive by it every single day. It's either an infill project where it's a single family home that now is zoned in a commercial area because it was the old downtown where residential homes were built right around it. Now they've restructured and repositioned a lot of those assets. So you go into these areas and you can level those homes, and now you go dense with them, where they may be overpriced for a single family home, but they're not overpriced if you go dense where you do multi-unit. That's where the value comes in, is how do I create the density I need to pay for this overpriced piece of land and make a viable project where there's financial returns. Then there's land that is sitting right outside the growing areas in the progressive growth plan of the cities. I always tell people, follow public transit. As you follow public transit only goes where people need to be. So if there's retail going in, if there's hospitals going in, if there's schools going in, there's businesses going in, that's where public transit goes. They're not going to take you out of the middle of Timbuktu. They're going to go in, and public transit is going to follow progressive growth. So if you follow public transit, you follow progressive growth. That's where you buy real estate like this to come in and start developing, because you're just staying right in front of the growth that the city development planners have put in place for the city. Okay, they've done tons of research. Don't try to reinvent the wheel. Don't go off on your own wheelhouse. Just follow progressive growth of any city. Now, when you go in and you find your magical piece of land, right? You find your infill project, you find your piece of land, you're sitting back going, I love that piece of land. I wish I could take that down, but I have no money. And now I'm limited on funds. How do I go in? How do I take this down? Why limit my liability, increase the viability of this project, and ultimately get to a place where the bank will come in and take the equity that I've created in this asset to be able to take down the land on my behalf and actually pay for it. So here's what you do. You go in, you put a purchase agreement together. Initially, you put a letter of intent together, and I'm trying to leverage as much time as possible. Once I put a letter of intent together, that means that I know enough about that property where I love it enough that I'm willing to put the time and effort in that it takes to talk to the city, the municipality, the code enforcement, the fire marshal's office, and all the working agencies that's going to ultimately approve my project to build it. And so once I love it enough in that regards, I haven't even penciled it. I don't know if it's even going to work financially yet. I don't even know what's involved in utilities. Don't put the cart in front of the horse, guys. There's a process and a system to this. Those questions have to get answered. They will get answered. You're going to work towards those. But first things first, get a letter of intent together. The letter of intent, you could burn 2-3 weeks going back and forth just with a letter of intent. They already know you're interested in it. They're not going to sell it to somebody else if your letter of intent within a threshold of reason and you're communicating with the seller. Now, as you're doing this, I'm buying a little bit of time. You're burning a couple days. You're working through logistics of the purchase agreement that's going to be drafted from the letter of intent. And now this letter of intent buys you 2-3 weeks. How do you utilize that time? Well, you go in, you start working on surveys, you start going in, talking to the utility companies. How do I get electric? How do I get gas? If you're going to need gas, a lot of times I try to omit gas, do all electric, all green builds, and then gas becomes a mute point and it reduces the overall cost of your bill. Then I go in, I talk about water and sewer. How is my water going to function? How does my sewer going to be connected? Now, those items are very important because those are big variables in regards to cost for infrastructure. And then I start talking to the city about zoning. If we go in, I usually will start onboarding an architect that understands whatever asset class that I'm going into, whether it's warehouse, multifamily, single family, build to rent, whatever it is. And I go in and secure an architect that's already done some of these projects in the area. How do you find them? You drive by a project, you get the address up, you go into that same city, municipality. It's all public record. If you go into their website and you open up their website, you can go in, put in the address, their permits pull up, you can scroll in on their plans that they submit, and when you scroll in, it's going to have the architect's name on there. All you do is you take that name, you Google it for their phone number. A lot of times their phone number is already on there, and then you just go in and you give them a call and you say, hey, I noticed that you guys did a project on XYZ Street by downtown St. Louis, Missouri, whatever it is. And you say, I love your project. Do you have interest in doing more projects like that? I have a very similar project that I'm looking to put together on the intersection of BKL intersection, whatever it is, right? And then you go in and they say, yes, I'd love to look at it. And then you go in and you say, look, I'd like to maximize the density on this 1.15 acre lot, right? Just a small lot. And so you sit back and you go, okay, we're going to maximize the density. What type of asset class do you want to do? Oh, I want to do multifamily. Okay, multifamily. What do you want to do? Well, I don't know yet. So now here comes part two. Now you go out and you onboard your real estate brokers that specialize in multifamily in that area and your property management companies. And now you're looking for pro formas. You want to get affirmation, like what's needed here. It doesn't matter what Jerome wants, doesn't matter what you want. It doesn't matter what anybody wants except for what's needed in that area. You know who has that information? The brokers have that information. You know who else has that information? The property management companies have that information. How and why do they have that information? Because they're there working in that market. Those are the people that know what people are asking for, that there's a deficit of. That's what you build. You don't build what you want. You build what there's a deficit of, what people are in need of that nobody has and can get filled in that area. Now, once you go in and confirm that deficit, now you have some working pieces going, right? Now you're getting all this stuff done at a time you don't even have a purchase agreement yet. It hasn't costed you any money. You're onboarding all these people. They're going to work for you. They're getting the data for you, and you're doing research. Now you get to a place your letter of intent is taken. They accept it. Now you're going to go into purchase agreement. Now you burn another 2-3 weeks going in and having your attorney. You may not even have an attorney. Just tell them my attorney is going to look over it. Maybe you are your own representing attorney, whatever that looks like, right? Or you actually have a real estate attorney in your area that reviews it for you, which is what I recommend. And you go in and you have them do a simple review of your purchase agreement. Now, whether you guys are going back and forth, you burn another 2-3 weeks just going back and forth. You're already 6 weeks into this and you haven't even committed to the lot, no money out of pocket, and you're doing research. So if all crashes down on you in that time period, you've wasted nothing more than some logistical time that you could go out, just walk out of the deal, and nothing lost, nothing gained. You move on to the next one, right? Zero money out of pocket to do your research. Now, by this time, I usually know if the deal is going to be viable. So now the purchase agreement is going in. You go in with your purchase agreement being submitted, and you start executing on follow through on your pro formas. Now, for those of you guys that haven't attended my Build Wealth workshop, you need to, because this is where we go in, we take our high level underwriting, we understand what is my real cost to build. Now we understand what the density is. We understand what the zoning looks like. We might have to go in for approvals. We may have another few months to go through approvals on it, but at least now we know that the zoning that is available to us, the area may support it. We went in and talked to the city to see if they're going to support the direction that we're going. If the city tells you, no, we're not going to support that because this is not what that's zoned for, we're not going to support any of that, that doesn't mean you can't apply, but it doesn't mean you're going to get approved either. It's always good to know that the city has your back and they support the business model of what you're looking to do. And so if you get the city going, you know what, we love the idea, we would love nothing more than support multi-unit real estate in that area, we have a housing deficit, we would love to be able to see some affordable housing or whatever it might be, go into that area. We will support you on it and we need it. Okay, great. Now, this is where you go and say, okay, I got the city that they'll support it. Does it mean it's going to get approved? No. You have to go through the formal process, guys, the formal process of zoning and specific use approvals. Now, we haven't even tied up the land yet, right? Now, we're going in, we're getting affirmation. Now we go in and we put a purchase agreement together. We know the direction we're going. Now we put our architect to work. We're increasing our density. We're doing our underwriting. We're saying, okay, I can get get 25 units of multifamily on here. The market tells me they need 2 bedrooms, maybe a few 1 bedrooms. We're going to go to market with a few 1 bedrooms and whatever that percentage is. Now we go in and we underwrite the cost to build that asset. What is it going to cost me to build this 20 some odd unit development? Now we take the cost to build that asset and we go, okay, what are the rents? The property management company tells us what they're charging for other like product in that area. And they say what the amounts that they're getting for those rents. Now we take those numbers because we know that in that area, those rents are viable. We take those numbers and based on those numbers, we underwrite it for the value of that asset based on revenue, okay? Based on revenue. We assume the occupancy. We take the occupancy that's leased up in that area. If it's 85%, you take 85%. If it's 95%, you take 95%. And now you underwrite the value of that asset. Now you know what it's going to cost to build and you know the value of that asset. Now you know if you have a viable project. By that time, you have a purchase agreement. Now you have something. Now when you go in, you're not as worried. You're still zero money out of pocket. You've had a lot of people doing free work for you because they want to retain your business, manage your property, ultimately broker the property for you, and ultimately go in and help this thing come into fruition because then all those parties land up making money on your development. Now you go in with an escrow money check to tie up the piece of land. Maybe it's $5,000, maybe it's $10,000. You tie up the piece of land that's maybe a $200,000 piece of land. You have it secured. In that purchase agreement, you're going to tell them that you're going to close on it. You need 60 days worth of due diligence. You've already done almost 60 days worth of due diligence, but now you still need 60 days worth of due diligence from the time that you tie up that property. So you have 60 days worth of due diligence and then 60 days post-close, which means you have 60 days to do more research on the property and then 60 days to close on the property. That's 120 days before you have to come to the table and purchase that. Now, it may take you longer in some municipalities, especially if you're going to get bank lending. By the time you get architects, engineers, and everybody to get a finished working set of prints to go to the bank with and to go in for permits, it may take you 3-4 months. And so you may want a little bit more time. Plus, you might have to go through municipal approval, right? That might take 2 and 3 months in itself. So now what you do is you make a contingency based on the density that you need, that you underwrote on that paper while you were tying up the land. And so what you do is you say, hey, this purchase is contingent though. So I have my 60-day due diligence, 60-day closing contingent, but my closing and my due diligence period is contingent on a minimum density of, that line, a minimum density of XYZ amount of units, XYZ amount of lots. And now you go in and you go after that approval. And so when you get 90 days down the road and you still don't have an approval, but you're showing active moving parts to getting approvals, if you just do nothing, they're not going to give you an extension. But if you show that you're working towards that and you have that contingency baked in there, guess what? Now you have something that gives you the ability to extend that due diligence based on that contingency. You have the ability to extend that closing period based on that contingency. And now you can put the working pieces together. You go in, you exercise an extension, and ultimately go in and get approvals. Okay? Now, as you get those municipal approvals, you're working all the pieces of your architecture, your engineering. You're getting to the finish line of being able to get this thing permit ready and finance ready. And ladies and gentlemen, as you work through that, that's the process that you need because you control the land. Your money's in escrow. You have a contract. It's a contractual obligation. It's a legal obligation. Your money's sitting at the title company with the escrow attorney or the escrow officer. And now you have something that you control the land, even though you don't own it, but you're not incurring interest payments and liability while you do this. So at the end of the day, instead of owning a $200,000 piece of land that you can't do shit with and you're gonna have a hard time selling, you might be $10,000, $15,000, $20,000 into a deal that yes, maybe you have the opportunity that you might lose it potentially, but that's where your front end workload comes into play so you can ensure that you don't lose it because we don't want to lose anything. But at worst case scenario, you lose 20,000 instead of 200,000. And so that's how you mitigate risk and ultimately go in with very little amount of money to no money out of your pocket. And as that land becomes entitled, that $200,000 purchase becomes a $2 million, $1.5 million piece of land through the entitlements that you've created. The value that you create in equity in that land is what you collateralize as the equity stack against that build and ultimately reduces your out-of-pocket expenses to go out and leverage that asset and take it out of the ground and go vertical. And ladies and gentlemen, when you exercise these tools, the way I'm explaining, you can go in with very little to no money out of pocket, control an asset, and ultimately get it out of the ground, but you have to follow the process. For more tips, recommendations, and ultimately information that's going to help you crush it in the multifamily and single family market, click and subscribe to my YouTube channel and smash that thumbs up button because I know I crushed it for you. Follow for more content, get notified, and let's go out and compound your success.